Welcome back, guys. Thank you for visiting the channel. Today we are talking about regulation. Please support the channel by hitting the like button, which helps the YouTube algorithm and helps get this content to others in the crypto space. By subscribing to the channel, you allow this content to show up on your suggestions, and by clicking on notifications, you won't miss important market updates as they occur. Today, we are talking about regulations to try to paint a clearer picture and determine whether there is a real threat to the cryptocurrency markets. During the Bitcoin conference, Wyoming Senator Caitlin Long discussed their potential regulation proposal and helped to quell some of the fears surrounding this topic. She discussed the consumer protection focus and the market manipulations and how the crypto space lacks these regulations and allows investors to be at risk. To begin with, the decentralized blockchain technologies do offer the promise of dispersing the functions and custodial powers of the centralized banking system. While this represents a threat to the central banking system itself, the need for basic regulations are apparent since there are a number of new companies operating in this space. However, the power of the Federal Reserve should not be underestimated. Using the U.S. government as an example, the Federal Reserve is a privately owned organization that holds overt and vast legislative and economic power within this country. But this is what we can see. There is a tremendous amount of covert or undercover power within our political system, held by the Federal Reserve and the rest of the central banking system. The fintech industry, which promotes technological innovation in blockchain research and development, is a complex system extending to cryptocurrency and other financial trading markets. Supply chain management, enterprise systems adoption, and revolutionary innovations across many industries worldwide, with leading innovators in El Salvador and in Paraguay leading the charge in Bitcoin adoption as a national currency. Other countries, too, like China, are developing the framework for a digital fiat currency, their own digital yuan. So while China has been overtly threatening to ban Bitcoin, they are also behind the scenes developing their own digital yuan and developing partnerships with VeChain. So where is all of this going? How does it all get connected? The SEC has an ongoing case against Ripple, and this ruling could prove to be a landmark for the industry. Outside of this legal action, the regulations are generally vague and obscure. For example, crypto exchanges have no overarching regulation, as many other equity markets do. Coinbase, for example, is registered in most states with a money transmitter license, but not as an exchange. While the Office of the Comptroller of Currency has granted national trust charters to a handful of exchanges, the new chief has called for a review of crypto rules. So who are the agency departments behind the scenes working towards this? The SEC and CFTC already have a cross-agency working group on crypto. The House of Representatives passed a bill in April to create a digital asset working group with the SEC and the Commodity Futures Trading Commission, the CFTC. The group, which would include industry companies, would produce a report within a year on the regulatory framework for digital assets. The fate of that bill in the Senate is still unclear. So, the SEC believes that tokens that act like a security could fall under the Securities and Exchange Commission. The SEC's Gensler in his recent remarks said he was concerned about manipulation and is reviewing how to regulate crypto exchanges. Each time the SEC has rejected a Bitcoin ETF, the reason is that they're not confident in the integrity of the underlying foreign markets where they will be traded. So the SEC is really focused on market manipulation, not on the trading of cryptocurrency in and of itself. The CFTC currently oversees foreign currency exchange markets and commodities futures markets, and is eager to keep its oversight of currency markets overall. The CFTC doesn't have a permanent head yet, but Chris Brummer has reportedly been a lead candidate. He has a deep background in crypto and is well liked in the crypto industry. The IRS. The IRS ensures transactions that result in gains are properly taxed. Recently proposed changes that will require disclosure of cryptocurrency transfers worth more than $10,000. Representative Tom Emmer reintroduced a bill this week to require the IRS to create a safe harbor until it clarifies the issue of airdrops and hard forks. A bill has been proposed that would make gains from cryptocurrency equal or less than $200 non-taxable. This could not just apply to buying a cup of coffee with crypto that has appreciated in value, but also for other uses of crypto that are not for buying goods, such as, for those Cardano fans, identity verification. The Office of the Comptroller of Currency, the OCC. The OCC released an order last July clarifying that federally chartered banks and custody cryptocurrencies, which was seen as a positive step in the mainstreaming industry. Michael Hsu, who has been acting comptroller since May 10th, said Wednesday that the OCC, the Federal Reserve, and the FDIC are in talks for an intra-agency sprint team on crypto regulatory issues. The OCC still doesn't have a permanent leader, however. Michael Barr, a former Treasury Department official and former Ripple advisor, was slated to be nominated but was reportedly dropped due to opposition from, guess who, liberal Democrats. The Consumer Financial Protection Bureau, the CFPB. The CFPB in 2019 released a compliance assistance sandbox to give companies safe harbor and clarity on new fintech products or features. Under this program, it has issued approvals for PayActive, Synchrony Bank, and others. In October 2020, the CFPB announced plans to pass Section 1033, which will determine consumers' access to and control of their own financial data. The CFPB is interested in how data is produced from financial services, how consumers can access it, and how they can authorize third parties to access it. While the CFPB remained neutral during the Trump administration, the recent nomination of Rohit Chopra to the head of the CFPB is expected to bring more focus on protecting consumers. The expectation is a stronger focus on consumer protection and a stronger focus on using the authority that CFPB has to the fullest extent in order to protect consumers. That was said by John Pitts, policy lead at Plaid and former CFPB Deputy Assistant Director for Intergovernmental Affairs. Changes to Section 1033 could affect what financial data a consumer could send to apply for a particular loan, or clarify what protection consumers have when using this data. If something goes wrong, what happens and what protections do people have, Pitt said. Changes could also benefit minorities and underrepresented groups, a Biden administration priority, Pitt said. For example, some fintech apps analyze consumers' cash flows in their checking accounts rather than a credit score to underwrite loans. This would help minorities and underrepresented groups that haven't been able to build up a traditional credit score. For this to happen, banks need to allow consumers to share this data, which a new Section 1033 rule would do. The Financial Action Task Force, FATF, a group of 200 countries and jurisdictions that set international standards related to money laundering and terrorist financing, released a draft of new guidance on regulating digital assets in March 2021, which would require crypto companies to collect and report detailed, personally identified information about their customers, their counterparties, and which other types of financial firms are operating in conjunction with that investor. This is what this type of oversight is not typical for financial firms in the industry. The firm released a statement saying such an ill-advised regulation will have many foreseeable and unintended negative consequences. The Financial Enforcement Network, the FinCEN, operating under the Treasury Department, requires only those controlling the assets to be regulated as money transmitters. The most recent draft guidelines suggest prohibiting peer-to-peer cryptocurrencies and privacy coins. The guidelines would also add counterparty identification, similar to what FinCEN recently proposed in a rule that was hotly contested by Coinbase and other exchanges. FinCEN hasn't made a decision on that proposal rule yet. Outside of the U.S., China regulators have effectively banned financial institutions and payment companies from most uses of cryptocurrencies. Chinese citizens can still trade crypto, but often need to do it through offshore exchanges. Yet the country remains interested in its own digital currency, including creation of a digital yuan and partnerships with VeChain. The Digital Commodity Exchange Act is one regulation that has been recently proposed, and we'll talk about that a little bit here. Last year, then Representative Mike Conway proposed the Digital Commodity Exchange Act, or the DCEA, which calls for the creation of new regulations targeting digital commodity exchanges. Under the DCEA, crypto exchanges could opt in to fall under the CFTC's new regulation. The DCEA bill would resolve the concern over Bitcoin ETFs because the ETFs could trade on CFTC-supervised markets. That bill would also allow token sales to proceed as regulated securities under the SEC's purview, and then, if they pass a certain test, become commodities overseen by the CFTC. This could resolve questions about when an SAFT, otherwise known as a project that raises capital for a future planned token as a security offering, later becomes a commodity that can be freely traded. So as we can see, the current regulations in the being proposed in the market are generally directed at market manipulation and consumer protection. The IRS, of course, wants their money and will continue to develop new laws that will allow people to pay more taxes. But as far as lower transaction fees, especially for using cryptocurrencies for consumers, such as buying a cup of coffee, the IRS is open and developing regulations that will help modify these rules to make them more crypto friendly. So based on what we can see in the current regulatory environment, many of these regulations are not that threatening to investors. I think a lot of what we're seeing is mostly fear-based and the propagation of a lot of FUD. So we are experiencing some downside, and I do not think the fundamentals have changed, and the regulations that are currently being proposed do not offer any reason to be fearful. That's all I got for you guys today. Thank you for joining the channel. Please hit the like button and help out the algorithm. And please subscribe and turn on all notifications. I will keep you guys updated if any of the policies or regulations are changing. Thank you, and have a great day.